Are we at a turning point in this market? One ETF is built to spot it before everyone else. Joining me now is Tian Yang, Chief Investment Officer at Variant Perception. Tian, great to have you on.
Thanks for having me.
So the fund is VPX, the Variant Perception Cycle Aware US Equity ETF. I want to know, what are your models signaling to you right now? Are we at a turning point here?
Yeah, I think from the business cycle point of view, the US economy still looks pretty resilient. So we build various lead indicators to understand how different sectors of the economy are operating. And right now, that hasn't been impacted too much by the Iran war. And in terms of some of the more tactical short-term models, we've seen a decent amount of what we would say LPPL crash exhaustions into the end of March. So those are typically reflections of panic selling in the market. And obviously since then in April, the market has obviously started to find its feet. So yeah, broadly speaking, it still looks like the bull market in US equities is intact. And then from a fair value point of view, what's been very interesting throughout the Iran war volatility is that a lot of the earnings estimates related to AI semiconductors have continued to be very strong. And a lot of our capital cycle and fair value models continues to see a lot of upside for the names that are exposed to those sectors, which obviously is like the biggest part of the US economy. And in fact, what you've seen throughout the past few weeks is that those sectors have been pretty resilient, and on any kind of good news, the AI names are actually rallying, right? So even now, semiconductors have broken out to new highs, even if the overall market hasn't. So again, there's some market behavioral factors as well showing that even though at headline level there's been concerns around Iran, some noise, bit of market volatility, the underlying fundamentals remain pretty strong for the AI and semi exposure. And if they're the biggest part of the US equity market, that obviously will provide a pretty good tailwind for US equities as a whole.
So what would you say the biggest thing the market is getting wrong right now is?
So ultimately, there's probably like a sequencing involved. So I think, especially in the age of AI, I think all investors are getting smarter, trying to understand what's going on and getting the first order analysis correct. But maybe I would say an easy mistake to make is to underestimate the fact that markets are reflexive, right? So for every event that happens, it tends to set off a lot of like offsetting factors. Iran war being a good example where, yes, in isolation, if you get a shock and then policymakers don't react and people don't react, you can get pretty, immediate kind of damage done to the economy. But because policymakers look at it, they respond with SPR releases, they respond with, trying to calm the markets down. You tend to have a more elongated effect, and you see this a lot in different shocks. Going back to we had Liberation Day before, even going back to COVID, and I think the ability for equity markets to actually look through a lot of these shocks is related to this idea of trying to price in the reflexivity of the markets and the fact that there's these second order impacts that come through. So I think as of right now, well, obviously this month the market has got a lot more relaxed about the war and things have somewhat normalized. So I guess from here, I would say markets are reasonably comfortable with the short-term shock, but perhaps what markets might be underestimating is that in terms of if you take a step back at the bigger cycle, we are now going to the second half of the year where there's some major blockbuster IPOs that are slated to come to market, things like SpaceX IPO, potentially Anthropic in Q4. So there's going to be some more equity supply to come, which can generate their own kind of excitement and help drive the markets. But equally, that requires a bit more kind of macro liquidity support as well. So that might be something to look out for as the year goes on. For potentially some downside risk, right? Given the markets are relatively relaxed on Iran, but for the short term, I think a lot of the shocks is basically in the rearview mirror here.
And just clarify, that would be downside risk because money that could be going into other areas of the market right now would be going into these IPOs?
Yeah, so in general, there's we have a concept we think about called excess liquidity, which is essentially, if you're creating lots of money in the system, that money has to go somewhere, right? It goes into savings, it goes into assets. And so one of the ways money gets created is clearly central banks, they cut interest rates. And if it doesn't generate a lot of inflation, that money can actually flow into asset markets and support asset prices. One of the kind of consequences potentially of the Iran war is that because of the higher oil prices, you're going to have a slightly higher steady state of inflation for a few months. It's going to prevent central banks from easing policy as aggressively as they would have. So at the margin, you have a bit less excess liquidity available for equity markets. Normally, that's not a huge problem, but because we have this, a lot of this excitement around one particular part of the market with AI, with a lot of the exposures and SpaceX, you potentially have that's going to start sucking money in from the other sectors in the market that will lead to a bit more of a narrow equity market. Obviously, so far this year has been a fairly broad market with a lot of sectors participating, but at the margin, I think the consequences around war is that it will potentially lead to more of a narrowing of the market and more of a concentration of capital into kind of these more um, more kind of exciting sectors that investors are focused on.
Okay, so your fund combines macro and quant, a man and the machine approach to help investors make better decisions. So at a high level, what does VPX actually hold? And then what triggers you to change positioning?
Yep. Yeah, so it tends to be driven off one is the business cycle models in terms of thinking about are there upside or downside risks on growth and inflation and policy. So right now, broadly speaking, it's a fairly benign outlook still for the macroeconomy, which means we're generally going to be invested. And then from a sector point of view, it's generally going to be driven off our models on capital cycle and quality of stocks, which we then turn into fair value estimates. So as of right now, we find that tech sector as a whole is still the most attractive. Valuations look really good, especially on the price earnings to growth adjusted basis. So taking into account the growth trajectory, broadly speaking, the sector is cheap. We like the semiconductors, the things linked to AI, the bottleneck sectors. Still, I think there is a lot of general concerns that yes, semis are ultimately cyclical industries and they're potentially over earning if this was a normal cycle. But I think we're still of the opinion, and our models are kind of backing it up, saying that this is a fairly persistent secular shift for a while. Just at a high level, global semiconductor spending is about 0.9% of GDP right now in aggregate. If you think semiconductors are going to become like the new oil, right? The fundamental component that starts driving economies going forwards. Well, oil consumption tends to, fluctuate around 2% of GDP on average, and during supply shocks, it can go much higher as well. So even from a high level, kind of net addressable market point of view, there's still a decent amount of runway to go for semiconductors as a whole.
So safe to say your ETF is leaning risk on right now.
Yeah, so I mean, it's obviously risk on, risk off is the easy thing to say, but we are invested, and our sector tilts are more driven off where we think the capital cycle opportunities are, and that's really very much concentrated in semis with a bit of a slightly defensive tilt on healthcare as well. So it's not just a blanket risk on, risk off cyclical defensive. It still has a kind of and a quality valuation component. So actually, we have a slight barbell where it has a big overweight towards tech, in particular semis. We started leaning into some of the software names, but equally on the other side of the barbell, you have a little bit of the beat up healthcare names, and we actually still have a little bit of energy for now, which acts as a very natural hedge to kind of the kind of overweight tech position.
But so does the S&P 500. So what makes this ETF different from just owning the S&P?
Yeah, I think that's a fair question. So the main unique differentiator is going to be the capital cycle. So this is about trying to quantify relative industry competition, which areas of the economy and markets you're seeing kind of very high marginal returns at the same time as a relative lack of investment into the industry. So in general, the way we think about investing over the medium term is that if a particular industry gets very hyped up, lots of money will flow into it. That'll create a lot of capacity that comes online, and that reduces future profitability and vice versa. And what we're seeing right now is that within a lot of the semiconductor supply chain, a lot of the bottlenecks are real, and the investment is just coming, but it's not actually quite coming online yet. So you're still kind of in a relative sweet spot. Now, over time, obviously with S&P, it's just going to stay market cap weighted and momentum driven. But with our capital cycle models, the idea is that you would be rotating sectors as we go. So for example, over the past 6 to 12 months, we've had a very big energy overweight, like way bigger than S&P, right? The weighting of the S&P, of energy S&P tends to be very small, but the capital cycle models did actually pick up on the need for a much bigger energy tilt coming into the year and obviously into this kind of crisis. So yeah, the basic idea is almost to take the raw ingredients of what is in S&P, but use the capital cycle to really drive the sector tilts to try and capture these sources of outperformance over time.
Okay, so just to bring it back to how we started, if it's a yes or no question, is this market at a turning point, yes or no? And what does that actually mean for investors? What should they be doing now?
Yeah, well, I think again, if we were recording the conversation 2 weeks ago when S&P was actually down, it would have been easier to say it's a turning point, right? I would argue we've kind of already had that turning point up. We don't. So I would say it's probably more of a continuation of right now, more of a continuation of the underlying bull market we've had in U.S. equities. The U.S. economy looks relatively resilient, so I think investors should probably generally just stay calm, keep their equity exposure, and we would say, despite a lot of the concerns around valuations on some of the tech and semi side of the market, we've seen a pretty decent reset already. So there's no real reason to panic and get rid of a lot of the tech and semi exposures too early.
Okay, a fair point. The S&P 500 is up more than 6% in April, having a good month, a good week. Tian Yang, Chief Investment Officer at Variant Perception, thank you so much for shedding some light on VPX and for your perspective. Really appreciate it.
Thanks for having me.